Is it possible to do better than Warren Buffett by just picking the best companies out of his portfolio and leaving the other ones out? Probably not as simple as it sounds, but let's give it a try. Grab a drink, take a seat. Let me show you what I got. What's up, y'all? It's Brian. This is my YouTube investing portfolio series where I invest in a different company every single week. And because it's a new company every week, I have to get creative with how I find investment-worthy companies. I've used several different strategies, many leveraging ChatGPT or other AI, but my latest strategy has been really easy. Start with a collection of companies handpicked by the greatest investor of all time, and then use the discounted future free cash flow method to find the ones that are on sale today. First, I pull up Warren Buffett's whole portfolio. You can see he's got lots of different companies. It shows what percentage of his portfolio, how much he's added or reduced recently, which is all really great. So I take that list and I made a custom stock screener on stockanalysis.com right here. So I entered all these in, and I also added 6 of my personal favorite screeners. First, we have price to free cash flow ratio. This tells me how much free cash flow am I getting for the price of the stock today. I like to use that over PE ratio, price to earnings ratio. However, I do still have it on here just to quickly see how profitable are they. Because some of these companies, if they have a dash, they had a bad year last year, or they're just not profitable. So I do like to see that. Next 5 years of growth in revenue, gross margin, operating margin, and profit margin. I like to see really high profit margins because the better the profit margins and gross margins they have, the more pricing power, the more of a competitive advantage that the company has, which I like to look for. So in this case, I like to start by looking at the price to free cash flow ratio. This is what I have filtered this list by, with the lowest at the top. And then I look at which one of these really low price to free cash flow ratio companies are standing out with the other metrics as well. Last week, actually, I don't want to spoil which one I invested in last week, but I'm going to just casually scroll past it. So one that really sticks out to me is AXP, because not only is it towards the bottom of the list on free cash flow, has a really high gross margin, really high operating margin, and profit margin compared to its surrounding companies at this lower tranche of free cash flow. So this is the one we're looking at. This is American Express Company trading at $255 per share. So the way I perform a discounted future free cash flow analysis is I use my automated spreadsheet, which makes this way easier. All I have to do is type in the ticker for the company right here, and then everything in this section gets filled out automatically. It pulls revenue, gross profit, gross margin, blah, 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 all of that from stockanalysis.com, and then performs the calculation on this page right here for what is the intrinsic value of the company using its future free cash flows. So one thing that goes into figuring out what is the future free cash flow is what is the future revenue for the company. To find the future revenues, I like to go back to stockanalysis.com, go to this forecast section, and right here, it shows revenue growth. This is what the analysts think American Express revenue is going to be over the next 5 years. For some reason, they don't have analyst predictions for 2025. So for that gap in the data, I'm going to go to American Express Q4 results. This is where they talk about on their investor presentations. That's where you can typically find just a quick overview of how they did for the most recent quarter, as well as their future guidance for the next year. And right here, fiscal year 2025 guidance for revenue growth, they're saying they're going to go up 8 to 10% in revenue, going back to stock analysis. So 2026, the highest analysts are 16%, the lowest are 2.6. I'm going to plug in 10 at the top and then 8 at the bottom with 9 as the average. So I just copied that into this section of my spreadsheet. I entered in the company's own guidance for fiscal year 2025. And based on these revenue predictions, the intrinsic value of American Express is somewhere between 760 and 520, which is absolutely insane. One more thing I left out. To find the free cash flow, I look at the past 5 years of free cash flow margin. That is the percentage of free cash flow that they get from their revenue. So I multiply their historic average free cash flow margin by the future revenue predictions to get their future free cash flow. And the past 5 years of free cash flow margin is 26.26%. Now, right here, you can see I took a percentage off. So this calculation is based on 25%. And the reason I did that is because I take into account the amount of cash they spend on capital expenditures, acquisitions, and stock compensation, and R&D, but American Express doesn't have any R&D. I will adjust their free cash flow based on how much they spend on some of these categories. The only one I'm adjusting, I have 0% adjustment on CapEx and acquisitions, but I am reducing their free cash flow by stock compensation. Normally, free cash flow is not reduced by stock compensation, but I will do that sometimes because with a company like American Express, one thing they do that I really like is they buy back shares. So if I go to their financials and their income statement, I can go down here to see shares outstanding diluted. So we can see that their share count is reducing every single year by 3%, 3%, 2.89, 2%, 4.8. So as they are reducing their shares, that is increasing my pie in the company. So I really like to see that. However, if I go to the cash flow statement, I can see that they do have stock-based compensation. So what that means is they're issuing new shares to employees. So this stock-based compensation is canceling out to some extent the amount that they're buying back. And I can see how the math works out on that down here. So we can see issuance of common stock. They are issuing shares, but then at the same time, they are purchasing them back, and they're purchasing back way more than they're issuing. So on whole, it's good. But I still am going to reduce their free cash flow by the amount that they're issuing because they're saving cash on salaries because they're issuing stock, but then they're turning around and having to buy back the stock. So it's like paying cash in extra steps. I'm going to reduce their free cash flow by the acquisition amount. And as a result, the new free cash flow margin is 25%. And I can also look at this graph right here. This shows their past free cash flow margin. So it was lower than 20% in fiscal year 2020, and then it spiked up to 38% or so, and now it's back down to 20. I'm just going with the average, which I think is a fair assumption. So based on that, we're looking really, really strong. I also have a projection for my projection and a past revenue projection. The past revenue projection uses the past revenue growth over the last 5 years, which is 14.15%. So obviously that one's going to be the highest because the analysts do not expect that high of revenue growth going forward. And then the my projection is where I enter in the revenue estimates that I think are going to happen. And really, I'm just throwing more of an average case in there. So in this case, I'm saying 5% annualized revenue growth over the next 5 years, 5% for the 5 years after that. So it's basically 5% for the next 10 years, and then a perpetual growth rate of 3%. Now, if that is the case, my projection is a intrinsic value of 543. And when the company is currently trading at 255, 256 this morning, it looks really, really strong. Now, one thing I also like to do is change my projection to see what is the market pricing American Express for? Like, does the market think there's going to be zero growth? And that's why it's priced so low. So if I put in zero growth, zero growth, zero growth, now I'm getting a projected share price of 261, which is now in line with their current share price. That's what I see when I look at how American Express is priced in the market. The market thinks this company is not growing at all. They have great free cash flow and they are currently buying back shares. They have a small dividend, so they're still returning value to shareholders, but there's not going to be any growth in the future. So if there is growth in the future at all, if there's anything, like if I just put in 1%, 1%, 1%, we're looking at a projected share price of 307, still a huge upside. So American Express really, really looks like it's on sale. Not only that, it's in Warren Buffett's portfolio, and Warren Buffett only picks companies that have a durable competitive advantage that he intends to hold forever. So he's got a great company. It seems like it's a really good price. One last thing I want to explain is this discount rate. This is the amount that I'm discounting future free cash flow. So the higher the discount rate, the lower the intrinsic value will be today based on those future cash flows. I currently have in there a discount rate of 7.61. I get that value from the cost of equity, which actually is up to 7.67. This is on alphaspread.com. It takes into account the volatility of the stock. It takes into account the risk-free rate, and it takes into account the extra return over the risk-free rate required by investors, which is 4.06. So this is subjective, this 4.06. For you, you might want a higher return above the risk-free rate, which is 4.26. I just go with what AlphaSpread has, so 7.67, and I'll just quickly adjust that in my portfolio and see what changes. It really doesn't make much of a difference. But if I wanted the discount rate to be, say, 10%, say I wanted a big discount, wanted to be very conservative, with 1% growth, that pushes my projection down to $220 per share, which that would make today's price a bit overvalued. If I go back to the growth projection that I had before at a 10% discount rate, then I'm seeing my projection of 346. Still, I absolutely love American Express. And this is the company that I'm going to be investing in this week. And now I quickly want to run through my portfolio and how it's done so far. We have $1,500 in the portfolio, $1,400 that's invested, which means we are currently down $37.58. That is a money weighted rate of return of negative 4.4%. We've only been going for about 15 weeks. And I am happy with the portfolio's performance so far because the S&P 500 has been taking a nosedive. So the goal for this portfolio is to focus on value investing, especially right now in today's market climate, because I think there's a high chance of recession. And if I'm investing in value companies, then I'm going to be a little bit more insulated by a recession. If I'm investing in growth companies tend to take a much bigger hit when the market is in a recession because people don't put as much money towards growth. The economy is not trying to grow. So growth companies suddenly don't have a good growth outlook, and then their share price drops a lot. Growth companies are typically priced higher than what their current profits would suggest. And then if they suddenly don't have the future growth, then the share price drops down to whatever their profits would suggest, which is a lot of times no profits. And then their future growth is hampered, which means people are also scared. There's also a lot of emotion whenever there's a market sell-off, and so people sell more than they should. So in any case, value companies are going to perform best in this kind of market environment. So that is what I'm investing in. So here are my holdings so far. Crocs, Hims, and British American Tobacco are my only companies that are still green through the bloodbath. And then we've got ACAM down 9%, Simply Good Foods down 7%, DocuSign 14.8%, HCA Healthcare 2.19%, Capital One Finance down 4.41%, Canadian Natural Resources down 6%, Google down 16%, and Zeta down 20%. So that's where we stand so far. If you're interested to see last week's video on this investing series, you can check it out right here, and I'll catch you over there. Cheers. Oh, yeah, that is a good one. Henry McKenna, tenure. Where's the kitties? Kitties?